The price of gold has risen substantially recently, taking many by surprise, and in fact it's hit 6-year highs recently. Price of silver has risen, but by nothing like the same sort of percentage margin, which means that the spread between the two has opened up to levels not seen in over 30 years. We're now at a reading of 92, that is 92 times the price of silver goes into the price of gold. What's all this mean? Well, let's catch up now with a small cap fund manager from the Junior Gold Fund. It's Angelos Damaskos. Welcome. It's good to talk to you again. It's been a long time since we have spoken to you. Good opportunity, though, with gold at these 6-year highs. I want your appraisal, first of all, as where we are and the speed with which we've got to this level on the price of gold.
Well, Jeremy, first of all, gold has been range-bound for a number of years, as you pointed out, and it has been this sort of resistance level of about $1,350 per ounce that has kept prices under control. Recently, we have seen gold break significantly and decisively above this resistance level, which indicates to us that we may be shifting into a higher trading range. And this is driven by several factors, but most importantly, geopolitics have worsened significantly. We have extreme tension in the Middle East. We have friction between Russia and the West. Russia's boisterous attitude and territorial claims continue to rub against the Western allies. We have friction between China and the US over trade. Potentially, all of these could spill over into a recessionary environment for the global economy. And all of these raise risks for investors. So investors naturally are looking, many investors at least, are looking to protect their portfolios by shifting some of their allocation to safe havens. And gold is the most important safe haven asset since antiquity. So people are buying bullion and gold-related equities.
In terms of who's buying, I'm interested to see, and I know your notes that you sent me earlier talk about the fact that it's central banks that have been doing a lot of the buying. Why? What is it that central banks see that many other in the markets have taken time to see?
Well, the most important thing to note is which central banks are buying. And we see the biggest buyers being Russian and Chinese central banks. And Russia obviously has responded to the sanctions imposed on it by the West, post-Crimea and other incidents, and have shifted their entire US Treasury holdings into gold. Russia has increased its holdings as a percentage of reserves from something like 3% in 2008 to 18.5% now. China has recently accelerated, that is in the last year, its gold bullion buying program. And it is interesting to notice that in 2008, the percentage of gold bullion backing the reserves was only 0.8%. And now it has risen to something like 2.6, 2.7%. So that's a massive shift of reserves into gold bullion. Then we have central banks of Turkey, which has responded to its economic crisis and has shifted significant part of its reserves to gold bullion because they want to protect against the value of their reserves against the depreciating lira. So we have these sort of important economic factors in the global landscape shifting part of the reserves into gold bullion and effectively de-dollarizing. Mm-hmm. In our reading, these people are not going to sell gold even if we get to $2,500 per ounce because they back their reserves with it. So effectively, a lot of bullion is being removed from the marketplace from easily available, tradable bullion. Now, if we think that financial investors choose, in the great majority, exchange-traded funds to acquire a position in gold bullion, these exchange-traded funds need to back the investors' issuance with gold bullion. So there is less gold bullion available in the marketplace to back those demands, and its price could rise significantly.
Yeah, we've been focusing on gold, but we should also be talking about silver as well, because it's part of the precious metal complex. Yeah. But that hasn't been rising, as I said at the top, hasn't been rising by the same sort of degree. And we've got this gap opening up, and as I said, it's now I think about 92, which is interesting. But interesting for what reason, first of all? What is it that indicates to somebody in the financial markets?
Well, first of all, the long-term average for the gold-silver ratio over 30 years is 66 times. Mm-hmm. So we are significantly above that ratio. That is indicating that silver has massively underperformed gold, and we can see that from the charts over the last 6 years. The explanation for that is that silver is not a pure safe haven metal. It has important industrial applications, and it has a lot of demand in photovoltaic, in information technology, smartphones, etc. But it does have a very strong influence to the safe haven seeking investors over the long term, and with a much more volatile nature to gold. And typically it lags the gold price development by 6 to 8 months. So we have noticed that on several occasions, most importantly after the 2008-2009 financial crisis, when gold started racing up to 1927. By 2011, silver lagged until the middle of 2010, and suddenly there was this hockey stick price action development that overtook gold, and silver raced up to $50 per ounce. Right. So it is much more volatile in price than gold, but it has the tendency to lag, and once a trend in the gold price is established, tends to outperform and rise by a significant margin.
Yeah, okay. All right, well, we'll look ahead to that as time goes by. I want to talk as well about opportunities within the stock markets. You're the fund manager for the Junior Gold Fund. What are you witnessing in terms of flows at the moment and interest in your fund?
Well, Jeremy, by way of mandate, this fund invests in the smaller companies that are the growth engines of the industry. They are the companies that have discovered promising deposits and are advancing them to production. So in times of a bear market, such as we have been since 2011, really, for the gold space, investors seek the safety of size and mature production to protect the downside and protect their capital. Mm-hmm. So investors have naturally focused on the larger capitalization producers and the larger mid-cap producers, which have outperformed for the period, and most importantly have outperformed in the last year or so, when the gold price was fluctuating around between $1,200 and $1,300 an ounce, with a strong bias to the downside, and people were very, very concerned that we would see much lower prices. So the smaller companies were almost totally ignored and overlooked by investors for the reasons I explained. Now we have seen in the last few weeks increased interest in those names, and I think it is natural to assume that if prices of gold and silver, for that matter, remain at this higher trading level, it is a transformational event for the smaller companies, and their share prices should re-rate dramatically.
What's your fund look like at the moment in terms of the spread between explorers, developers and producers?
Well, we have refocused a little bit the fund's portfolio. If you remember a few years back in the depths of the bear market, late 2015, 2016, we were almost exclusively focused on mid to low, smaller capitalization producers. We avoided explorers because it was evident that companies had extreme difficulty raising financing. After the recovery rally of 2016 and then the consolidating situation for the next 2 years, we have gradually shifted the portfolio to the development stage. That is, companies that have identified very prospective reserves and very large deposits and are advancing to feasibility studies and towards production. So at the moment, the portfolio comprises approximately 55% producing companies, and the rest being late-stage development companies almost ready to finance their projects, and some what I call late-stage exploration companies. That is, companies that have identified meaningful reserves and are continuing their drilling programs to expand the reserves and resources and develop them into something more meaningful. Mm. So there is a lot of embedded, if you like, operational gearing to the metal prices as these deposits move forward and prove up their worth First of all, there could be the prime takeover targets from the larger companies.
What about the risk? We've spoken to you before about where those companies are that you're interested in. I think you tend to go geopolitically. You tend to go fairly safe jurisdictions. Do you keep that going? Or?
Absolutely. That is the cornerstone of our investing principle. We avoid political risk because we take enough risk with the commodity volatility, not having to worry about someone directly or indirectly expropriating our assets. So we tend to stick to politically safe territories. A big proportion of our investments are in North America, probably approximately 40%. With the rest being split between Australia, West Africa and Latin America.
Just want to quickly go back to the gold price if we can. This weekly chart here, which shows the breakout on the right-hand side. Where would you expect to see this later in the year? I mean, do we have much more upside to go here? You're talking here about this layer of resistance coming up just ahead of where we are. Do you see that easily broken, or is that going to be a difficult task?
Well, it's a little bit difficult to read given the speed of the situation and the interest it has attracted from the investment community. It is evident that it's a multi-year resistance level that we have broken, so it is not unlikely we could run up to $1,500 per ounce. I've often said that our immediate target is $1,450 and some consolidation around that level, so it fits in a trading bands between $1,400 and $1,500 per ounce. But if we say a flare-up in the Middle Eastern situation, for example, we could easily see gold spiking up to 1,600 plus very quickly. The question is, where are we going to settle trading going forward? And I think given the macroeconomic situation with a potential recession looming for the world, the huge debt levels that we have spoken about in recent discussions that are still 320% of global GDP, and the trade wars that could also provide a brake on global economic growth, it is not unlikely that gold will remain well above 1,400 for the foreseeable future.
Yeah. Okay. Well, look, it's a pleasure talking to you. Thanks indeed for popping back in and discussing your fund amongst other things, and also that gold to silver ratio. That was Angelos Damaskos from the Junior Gold Fund.